Good morning. Today, we're diving into a story that's affecting millions of people every time they pull up to the gas pump. Whether you're commuting to work, planning a road trip, or just running errands, the price you pay for fuel is more unpredictable than ever. If you've filled up your car lately, you've seen gas prices jump. Again, it's not just a minor uptick. For many, it's a real shock to the wallet, with some drivers even changing their routines or cutting back on travel. On December 29, 2025, oil prices surged after a sharp drop just days before, leaving everyone wondering, what's driving this wild ride? The swings have been so dramatic that even seasoned analysts are struggling to keep up. The two main oil benchmarks, Brent and WTI, both rose nearly 2%, signaling a real shift in market sentiment. These benchmarks are watched closely by traders, governments, and businesses worldwide, as they set the tone for global energy costs. These numbers aren't just statistics, they directly impact what we pay for fuel and goods. When oil prices rise, transportation costs go up, and that can mean higher prices for everything from groceries to online deliveries. The recent spike followed a brief dip, which had given hope for lower prices. For a moment it seemed like relief was on the horizon, but the market quickly reversed course, dashing those hopes. But oil prices are incredibly sensitive to global events, especially international diplomacy. Even a single headline or rumor can send prices soaring or tumbling within minutes. The main culprit? The ongoing conflict in Ukraine and the high-stakes peace talks to end it. The world is watching closely, as any progress or setback in negotiations can instantly change the outlook for oil supply and demand. Hopes and fears around these negotiations are now the biggest force behind oil's daily swings. Traders react in real time, and their decisions ripple out to affect prices at the pump almost overnight. So, what does all this mean for you and your family? Let's break down what happened, and why it matters to you, your budget, and your everyday life. Last Friday, oil prices plunged in a dramatic fashion, sending shockwaves through financial markets around the world. The sudden drop caught many by surprise, as just days earlier, prices had been climbing steadily amid ongoing uncertainty. But this time, the catalyst was different. A surge of optimism that peace talks between Ukraine and Russia might finally yield results. On trading floors from New York to London, a wave of hope swept through the energy sector. News of the negotiations dominated headlines, and traders, analysts, and investors alike began to anticipate a possible end to the conflict that had rattled global markets for months. The U.S.-led negotiations, held at a high-profile international summit, sparked genuine hope that a breakthrough could be within reach. If successful, a deal would not only end the war, but also bring much-needed stability to global energy markets, which had been plagued by volatility and uncertainty. Traders quickly bet that peace would mean the lifting of harsh sanctions on Russia, one of the world's largest oil producers. The expectation was that Russian oil would soon flood back into the market, dramatically increasing supply and pushing prices even lower. As positive statements emerged from President Trump and President Zelensky, the mood on Wall Street and beyond shifted almost instantly. Markets reacted in real time, with traders scrambling to adjust their positions. The mere possibility of a diplomatic breakthrough triggered a massive sell-off. Traders rushed to offload oil contracts, eager to get ahead of what they believed would be a steep price drop if peace was achieved. This was a textbook example of markets trading on future expectations rather than current realities. Investors weren't waiting for a signed agreement, they were already pricing in the potential impact of peace. For a brief moment, hope and optimism filled the air. The idea that the conflict could end, and that energy markets might finally stabilize, was enough to lift spirits across the globe. Yet, even as leaders spoke with cautious optimism, they were quick to remind the world that significant obstacles remained. The path to peace would not be easy, and many difficult issues still needed to be resolved. Still, people everywhere watched the unfolding events with bated breath, hoping for a breakthrough that could finally bring an end to the conflict, and to the economic turmoil it had unleashed. The numbers on the trading screens reflected this collective hope, as markets responded to every new headline and statement from the negotiating table. But as we'll see, optimism in the oil market can be fleeting. The situation remained volatile, and the mood could shift just as quickly as it had changed. The peace talks set the stage for a dramatic reversal in the days to come. What happened next would surprise even the most seasoned market watchers. Over the weekend, the mood on global markets shifted dramatically. What began as cautious optimism quickly unraveled as traders and investors digested the latest headlines and realized that the path to peace was far more complicated than it first appeared. Details emerging from the high-stakes peace talks painted a sobering picture. Despite marathon sessions and intense negotiations, a final agreement remained elusive. The sticking points were significant, and both sides seemed unwilling to budge on the most critical issues. As the reality set in, the market's initial excitement gave way to a more cautious, even anxious atmosphere. Investors who had hoped for a breakthrough now faced the prospect of prolonged uncertainty, and the mood on trading floors turned tense. By Monday morning, it was clear to traders that sanctions on Russian oil would not be lifted anytime soon. With supply chains still constrained and no relief in sight, the market braced for continued tightness in global oil supplies. Those who had rushed to sell oil on Friday, betting on a quick resolution, now found themselves scrambling to buy it back. The sudden reversal sent prices soaring as traders tried to cover their positions and avoid deeper losses. The market, which had briefly celebrated the possibility of peace, now corrected its over-optimism. The focus shifted from hope to risk management, as everyone braced for more twists and turns in the days ahead. The dream of a swift resolution faded into the background, replaced by the sobering reality of a long, uncertain road ahead. The empty negotiation rooms stood as silent witnesses to the challenges that remained. With every new headline, uncertainty grew, and oil prices climbed higher. Traders and analysts alike adjusted their forecasts, preparing for a period of heightened volatility and unpredictability. The very statements that had sparked hope just days before now served as reminders of how far apart the parties remained. Each official comment was scrutinized for clues, but none offered real reassurance. It's a classic example of how quickly market sentiment can swing from euphoria to fear. In the world of oil trading, fortunes can change in an instant, and uncertainty is often the only constant. For everyday consumers, the hope for lower prices at the pump was suddenly put on hold. Rising oil prices meant higher costs for transportation, goods, and services, affecting people around the world. As headlines about oil volatility dominated the news, investors and consumers alike braced for more turbulence. The sense of unease was palpable, with everyone watching and waiting for the next development. And so, the oil roller coaster continued, its wild swings a reflection of a world still searching for stability, and a market that knows just how quickly hope can turn to uncertainty. The big question: when will Russian oil return to the market? Sanctions have sidelined millions of barrels, keeping prices high. A real peace deal could flood the market with Russian oil, sending prices down. But with talks stalled, traders expect Russian supply to stay restricted. This uncertainty makes it nearly impossible to predict future prices. In markets, uncertainty almost always means higher prices. Until there's a clear peace agreement, the Russian question will keep oil markets on edge. The world waits and pays the price for uncertainty. Oil prices aren't just about supply and demand. They include a geopolitical risk premium. Conflict and instability, like the war in Ukraine, add extra cost to every barrel. A credible peace deal would lower this risk premium, calming markets and cutting prices. But with talks faltering, that premium is back, keeping prices elevated. Every new threat or disruption adds to the cost. We're all paying a hidden tax for global instability. This risk premium isn't unique to Ukraine. Any conflict in a major oil region can drive prices up. Until peace returns, the world keeps paying for uncertainty at the pump. The economic cost of conflict is real, and it's in every gallon we buy. Despite fears of shortages, there's another force at play: the risk of too much oil. Experts warn that by 2026, global supply could outpace demand, capping price spikes. Non-OPEC countries like the U.S., Brazil, and Guyana are ramping up production. Meanwhile, economic growth is slowing, and clean energy is starting to dent oil demand. This tug-of-war, tight supply now, possible glut later, keeps prices volatile. If peace talks had succeeded, oversupply fears would have dominated, sending prices lower. For now, the market is caught between short-term conflict and long-term abundance. The result? A ceiling on how high prices can go. Oil's future is anything but certain. While Ukraine dominates headlines, Venezuela is quietly adding pressure to oil prices. U.S. sanctions have further restricted Venezuelan exports, tightening global supply. Every lost barrel matters, especially with Russian oil also limited. Venezuela's struggles are a reminder that geopolitics isn't just about one region. Tensions in Latin America, the Middle East, and Africa all impact oil flows. For traders, it's a global game of whack-a-mole. One crisis eases, another flares up. The Venezuelan situation adds another layer of uncertainty. It's proof that oil supply is vulnerable to political events worldwide. The market stays on edge, watching every hotspot. Oil prices are set by a constant dance between supply and demand. On the supply side, OPEC, Russia, sanctions, and conflicts all push prices up. On the demand side, global economic health, travel, and the shift to renewables pull prices down. The price you see is where these forces meet. Traders react instantly to news, betting on tight supply or weak demand. This push and pull makes oil one of the world's most volatile markets. Ukraine's stalemate pushed prices up. Oversupply fears keep them in check. Add in Venezuela and other hotspots, and the picture gets even more complex. Understanding this dance explains why oil prices and your costs are always moving. All these global forces hit home at the gas pump. When oil prices rise, it costs more to fill your car, ship goods, and fly. Higher energy costs ripple through the economy, raising prices on everything from groceries to travel. The key to relief? Progress in Ukraine peace talks. A breakthrough could send prices tumbling. More stalemate means higher costs. Meanwhile, rising production and slowing demand may help cap prices. By understanding these forces, you can better anticipate what's next at the pump. We'll keep you updated as this story unfolds.